Welcome back, everybody, to another deep dive. Today, we're diving into the world of dividend stocks.
Yeah, always a hot topic.
Always, yeah. And to guide us today, we've got a really interesting article from the Motley Fool. They look at 4 specific companies and an ETF as examples.
Yeah, a good range of sort of different areas in the market.
And we're going to kind of get into like why dividend investing has become so popular and, what's the big deal?
Yeah.
Like, what's so alluring about it?
Yeah, it's definitely, it's piqued a lot of interest. I mean, it's interesting, there was a Hartford Funds report that looked at 50 years of data from 1973 to 2023.
Okay.
And they found that stocks that pay dividends, particularly those that consistently grow their dividends, have outperformed non-dividend payers by a significant margin.
Really? By a significant margin?
Yeah, I mean, this is over a long period of time.
Yeah. So, like, for someone like me, just like a normal investor, like, what is that? What's the big takeaway from that?
I think the big takeaway is really the power of compounding, right? So when you reinvest those consistent dividend payouts, they generate more dividends, which you then reinvest, and the cycle continues. So over the long haul, this can really lead to, some impressive growth.
Yeah, it's that snowball effect.
Yeah, exactly. So it can really supercharge your returns.
Yeah. And I like that also you get those consistent payouts. It's kind of like a sense of stability.
Absolutely.
Especially in a turbulent market.
In a turbulent market, exactly.
Yeah. But I have to admit, like, I used to think this about dividend stocks.
Okay.
That it was just for, like, passive investors.
Yeah.
Or people who are nearing retirement.
Okay.
Like, just looking for that income, is that?
That's a very common misconception.
Okay.
It is. Yeah, the reality is that there are a lot of high-growth companies that also offer dividends.
Oh, really?
Yeah.
Okay.
Even tech giants like Apple and Nvidia pay dividends.
Oh, wow. Okay. So it's not just for those.
Yeah, it's not just for those.
Slower growth companies.
No, slower growth or income-oriented investors.
Got it.
Yeah.
Okay. So it's more dynamic than I thought.
Absolutely.
Okay. Let's get into some specifics here. So the article highlights Pfizer.
Yeah.
Of course, they've been all over the news the past couple of years because of the whole COVID-19 vaccine thing.
Absolutely.
But, they've got a pretty enticing dividend yield. I think it was like 6.6%.
Yeah, that's a pretty solid yield.
That's pretty good. And the valuation with that low forward PE ratio seems pretty appealing to me. But I'm not sure. I think that's a good point. I understand exactly what that is. Could you?
Yeah. So the forward PE ratio, it's basically a way to assess a company's value based on its projected future earnings.
Got it.
So a lower PE ratio can sometimes indicate that the market might be undervaluing the company.
Interesting.
Relative to its earning potential.
Okay.
There could be various reasons for that. It could be just short-term market sentiment, or perhaps investors haven't fully grasped the company's long-term growth prospects. But in Pfizer's case, you have their extensive drug portfolio.
Right.
They've made some strategic acquisitions recently, like Seagen, the oncology field. And then you also have the generally defensive nature of the healthcare sector.
Yeah, that's a good point. Even if the economy's bad, people still need their healthcare.
Exactly. People still need their medications and their treatments.
Exactly.
So that adds to their potential.
That makes a lot of sense.
Yeah.
So speaking of healthcare, the article also mentions Medtronic.
Yes. Another solid dividend payer.
Yeah. And they've got a very impressive track record of dividend payouts.
Extremely
consistently increasing their dividend for over 46 years.
That's a long time.
And they've currently got a yield of like 3.2%.
Yep.
I mean, that kind of consistency, I feel like that really suggests stability.
Absolutely.
Right.
Yeah, I mean, that's one of the things that's really impressive about Medtronic is their commitment to innovation.
Okay.
They have a really robust pipeline of new medical devices.
Okay.
And they're investing heavily in research and development.
Wow.
They spent something like $2.7 billion last year.
Really?
Yeah. So this continuous development of new products is really crucial for a company like Medtronic to stay ahead in the medical device industry.
Yeah.
And like Pfizer, they also benefit from operating in that defensive sectors.
Right.
So healthcare, people prioritize those needs even when the economy's not doing well.
Right. Healthcare is a necessity. You can't really put it off.
Exactly.
Wow.
It's not discretionary spending.
Yeah. Okay, so, and it's also worth noting that Medtronic's valuation, with that low forward PE ratio again,
Right.
compared to its historical average,
It does look attractive.
looks pretty good.
Yeah.
But I guess this is kind of a question for me.
Sure.
Sometimes I see like a really high dividend yield, and I kind of think like,
Okay.
is that a warning sign? Should I be concerned?
Yeah, that's a great point.
Like, what are the potential downsides there?
Yeah, you're right to be cautious.
Okay.
Because while a high dividend yield can be tempting,
Yeah.
it's important to consider why the yield might be so high.
Okay.
Sometimes a very high yield could signal.
Uh-oh.
Yeah.
Like underlying problems.
Yeah, underlying problems within the company,
Okay.
such as declining earnings
Okay.
or an unsustainable dividend payout ratio,
Okay.
which basically means they might be distributing more in dividends than they can realistically afford,
Right.
which could eventually lead to a dividend cut.
That would not be good.
Not a good situation.
Okay, so it's not as simple as just...
It's not.
Chasing the highest yield.
No, it's not.
Got it.
It's important to look beyond the surface
Okay.
and do your research.
All right, this next one's interesting. Realty Income.
Ah, yeah.
They're a REIT, right?
Yes.
And I know that they're known for those like consistent monthly dividend payouts.
Absolutely. Very popular for that reason.
And they've increased their dividend 108 consecutive times.
Yeah. It's pretty incredible.
That's a lot.
It is.
But I think for some of us maybe who aren't super familiar with REITs, can you kind of explain like what they are and what makes their dividend structure unique?
Yeah, so a REIT, or a real estate investment trust, is basically a company that owns and operates income-producing real estate.
Okay.
And a key feature of REITs is that they're required by law
Oh, wow.
to distribute a significant portion of their taxable income to shareholders as dividends.
Okay, so they have to.
They have to. It's a requirement.
Got it.
Which makes them very appealing to investors
Yeah, I can see.
who are seeking regular income.
Especially that monthly payout. I bet people like that.
Yeah, the monthly payout, that's not very common.
Not typical.
You know?
Yeah. Okay, and so the article also mentions their vast portfolio.
Yeah.
They have over 15,450 properties.
That's a lot of property.
That's a lot.
Yeah.
Across various industries,
Mm-hmm.
giving them a really diverse tenant base.
Yeah, very diversified.
And a wide geographical reach.
Geographically diversified as well.
It's got to help mitigate risk, right?
Absolutely. That's one of the key advantages
Okay.
of Realty Income is that they're so diversified
Okay.
that if one tenant faces difficulties
Right.
or one industry,
It's not going to take down the whole company.
the impact is minimal.
They've got their eggs in lots of different baskets.
Exactly.
But, I mean, with that long track record of dividend increases, like, how is that sustainable?
Yeah, that's a great question.
Like, what are the risks I should be aware of?
So while Realty Income's track record is very impressive,
Yeah.
it's important to remember that no investment is without risk.
Right, of course.
So some potential risks with Realty Income
Okay.
include interest rate sensitivity,
Okay.
because REITs often rely on borrowing to finance acquisitions,
Mm-hmm.
and then also economic downturns,
Okay.
which can obviously impact tenant occupancy
Right.
and rental income.
Yeah. So there's always going to be some risk.
So there's always going to be some risks.
Okay. So, I know researching and picking individual dividend stocks can be a lot of work,
It can be, yeah.
especially for, a novice investor,
Absolutely.
someone like me.
Yeah.
Are there like more simplified approaches?
Yeah, absolutely.
Okay.
If you're looking for a more hands-off approach, dividend-focused ETFs
Okay, yeah.
can be a great option.
So like the Schwab U.S. Dividend Equity ETF that the
Those.
article mentioned.
Yeah, that or similar ones can be a great starting point.
Okay, so you don't have to pick all the individual stocks.
Exactly.
Yeah.
They do the picking for you.
Okay, that makes a lot of sense.
Yeah.
But, I mean, how would I even start choosing specific dividend stocks if I wanted to go that route?
No, that's a great question.
Where do I even begin?
That's where having a framework
Okay.
for evaluating dividend stocks becomes really important.
Okay, so walk me through what are those key factors?
All right, so let's break it down.
Yeah.
One starting point is the dividend yield,
Okay.
which basically tells you how much income you'll receive
Right.
relative to the stock price.
Got it.
So a higher yield might seem attractive.
Of course,
doesn't.
surface, but
But there's got to be more to the story.
there's more to this story.
Yeah.
A very high yield can sometimes be a red flag, suggesting that the company might be struggling financially
Okay.
or paying out more in dividends
Right.
than they can sustainably afford.
Okay.
So,
What else should I be looking at?
So another key factor is the consistency and growth of those dividend payouts.
Gotcha.
So look for companies that have a history of steadily increasing
their dividends over time.
Okay.
This suggests a strong financial foundation and a commitment to rewarding shareholders.
Got it.
However, if a company has a history of like erratic dividend payouts or even dividend cuts, that could be a warning sign.
So basically, I'm looking for like a track record.
Exactly.
Are they sharing their profits?
Exactly. Are they consistent? Are they reliable?
Consistently.
Yeah.
Okay. And how important are companies' earnings when we're talking about this?
Earnings are fundamental.
Okay.
Dividends are ultimately paid out of a company's earnings.
Right.
So healthy and growing earnings are essential.
Okay.
Look for companies with a solid history of profitability and a positive outlook for future earnings growth.
Got it.
If a company's earnings are declining or inconsistent, their ability to maintain or grow their dividend
that makes sense.
could be at risk.
Their earnings are like the fuel.
Yeah, exactly. It's the fuel
For those dividend payments.
that powers those dividends.
Okay, so we've got dividend yield.
Yeah.
We've got consistency of payouts.
Okay.
We've got earnings growth.
Yeah.
What about valuation?
Valuation.
We talked about PE ratios earlier.
Yeah.
But how can I use that?
Yeah, so valuation metrics can help you determine if a stock is overpriced or undervalued.
Got it.
So like we saw with Pfizer and Medtronic,
Right.
a low PE ratio might suggest undervaluation, meaning the stock price might not fully reflect the company's earnings potential.
Okay.
But it's important to compare a company's PE ratio to its historical average and to industry peers to get a sense of its relative value.
So context is key.
Context is key. You can't just look at numbers in isolation.
Gotcha.
A stock with a high PE ratio compared to its peers could mean that investors have high expectations for future growth, but it could also mean that the stock is overvalued.
Okay, so it's all about comparing apples to apples. All right, we've covered a lot of the quantitative stuff.
We have.
What about the qualitative stuff?
Yeah.
How important is it to understand a company's business model?
Equally important.
Okay.
Yeah.
And like its competitive landscape.
Yeah. You want to invest in companies with a sustainable business model, a competitive advantage in their industry, and a strong management team.
Okay.
You wouldn't invest in a company with a product or service that's about to become obsolete, right?
Right.
So understanding a company's business model, their position in the market, and the quality of their leadership gives you a better idea of their long-term viability.
Right. So it's not just about crunching the numbers.
It's not just about the numbers.
It's about the whole picture.
It's about the whole picture.
Okay. Whoa. So we're looking for a company with a decent dividend yield, a history of consistent and growing payouts, solid earnings, with potential for future earnings growth, a reasonable valuation, and a sustainable business model.
That's a good checklist.
That's a lot.
It is a lot.
Okay.
But it's a solid framework for evaluating dividend stocks.
All right. And of course, don't forget diversification.
Absolutely. Diversification is your friend.
Okay.
Don't put all your eggs in one basket.
Right.
Invest in a range of companies across different sectors to spread risk.
Okay. And if this is all feeling a bit overwhelming,
I
can always go back to those ETFs.
You can always go back to those ETFs.
They do the heavy lifting for me.
Exactly. They do a lot of the work for you.
Okay. I like that.
Yeah.
All right. Now, you mentioned red flags like a high dividend yield or inconsistent payouts. What are some other things that should maybe make me raise an eyebrow?
Okay. Good question. So a high debt load can be a concern if a company has a lot of debt. They might be using those borrowed funds to finance their dividend payments, which is not sustainable in the long run.
Right.
You want to see a company generating enough cash flow from its operations to cover those dividend payments.
So it's not just about whether they're paying a dividend.
It's not just about whether they're paying it.
It's whether they can afford to pay it.
Can they afford to keep paying it?
Okay.
Yeah.
What else should I be looking for?
So another thing to pay attention to is the company's payout ratio, which basically tells you what percentage of its earnings is being paid out as dividends.
Okay.
A very high payout ratio, say over 80 or 90%, could be a sign that the company is stretching itself too thin and might not have enough earnings left over to reinvest in its growth.
Or to cover Were there any unexpected challenges?
Right, like if something unexpected happens and they've got
The
no wiggle room.
No wiggle room.
Okay, so high payout ratio.
Yeah, it's a sign of it. Could be a sign of
lack of financial flexibility.
like they're living paycheck to paycheck.
Exactly. Putting all their eggs in the dividend basket.
Right. And that's all they got.
Yeah.
All right. More and more these days, investors are looking at ESG.
Absolutely.
Those environmental, social, and governance considerations.
Yeah, that's a significant trend we're seeing.
Yeah.
Yeah, investors are becoming more conscious of the impact their investments have on the world.
Yeah.
They're looking for companies that are not just financially sound, but also operating ethically and sustainably.
Absolutely.
So this means considering factors like a company's environmental footprint, its social responsibility practices, and the strength of its corporate governance structure.
Yeah, so it's kind of like adding another layer
Another layer.
to due diligence.
Due diligence.
Yeah.
Yeah.
I like that we're not just looking at the numbers.
Not just the numbers.
We're looking at the bigger picture.
The bigger picture.
How do I even start to incorporate those factors into my analysis?
Yeah, so there are various ESG ratings and research resources available that can help you assess a company's ESG performance.
Got it.
You can also look directly at company reports and their websites to see how they're addressing ESG issues, what their sustainability goals are, and how they're engaging with stakeholders on these matters.
It's really cool to see how this ESG investing is becoming more and more mainstream.
It's going mainstream.
It's not just a niche thing anymore.
It's not a niche anymore.
Okay, so we've covered a lot today.
We have.
Everything from quantitative and qualitative aspects to ESG.
It's a lot to process.
It's a lot to process.
It's a lot to say.
But hopefully I feel better equipped to start exploring.
Good. It's a journey. Yeah. Investing is a journey.
Okay.
It's not a race.
Yeah.
Take your time, do your research, and don't be afraid to ask questions.
Absolutely. Knowledge is power.
It is.
All right. So speaking of expanding our knowledge, let's shift gears a bit and talk about a specific type of dividend stock.
Okay.
That's often overlooked, I think.
All right. I'm interested.
International dividend stocks.
Ooh, expanding our horizons beyond domestic markets.
I think sometimes people think international investing is like inherently riskier.
Yeah, that's a common perception.
Is that always true, though?
Well, while international markets can be more volatile, that volatility can also present opportunities for investors who are comfortable with a little bit more risk. And remember, diversification is key to managing risk.
Yeah.
So by including international dividend stocks in your portfolio, you're spreading your risk across different economies and currencies.
Yeah, so it's not just all U.S. dollars anymore.
Exactly.
So I'm intrigued.
Good.
Let's say I want to add some international flair.
Okay.
What are some of the key things I should be considering?
All right, so many of the same principles that we discussed earlier apply.
Okay.
Dividend yield, payout consistency, earnings growth valuation.
Yeah.
But with international stocks, there are some additional
what are those
factors to keep in mind?
The mole ears.
Okay, so currency fluctuations are a major consideration.
Okay.
The value of your investment can be impacted by changes in exchange rates between your home currency and the currency of the country where the company is based.
Okay, so let me make sure I understand this. So, like, if the U.S. dollar weakens against, say, the euro, and I own stock in a European company paying dividends in euros, my dividend income would be worth more in U.S. dollars when converted.
Exactly.
Okay.
But the reverse is also true.
Right.
If the U.S. dollar strengthens, your dividend income would be worth less.
When converted back.
When converted back to dollars.
Okay, so it's kind of like a built-in currency hedge.
It can act as a hedge.
But it also adds like a layer of complexity.
It does add complexity.
Okay, what else should I be aware of?
So another important factor is political and economic stability.
Right.
It's generally a good idea to invest in countries with stable governments, sound economic policies, and business-friendly environments.
Makes sense.
Emerging markets, while they often present potential for high growth.
Right. High risk, high reward.
Can also come with higher political and economic risk.
Yeah, so it's all about
balance.
Finding that balance between risk and potential reward.
Okay, so I should do my research on the countries situation.
Yeah, the country's overall.
Yeah, situation. Are there other like country-specific factors?
Yeah, absolutely. Different countries. Like regulations or anything?
Have different regulations when it comes to things like corporate governance, financial reporting, and even dividend payouts.
Oh, wow.
Yeah, so it's essential.
That's a whole different ballgame.
It is.
Yeah.
It's a whole different set of rules.
Are there any like resources that can help
Yes.
kind of simplify?
There are reputable research firms, financial websites, and international brokerage platforms that provide a wealth of information on international markets companies and those specific regulations that we talked about.
That's good. So I'm not just going in blind.
You don't have to go in blind.
But where do I even begin?
To
find these international...
A convenient and diversified way to tap into those global dividend opportunities is through international ETFs. Similar to the Schwab ETF we discussed earlier, but with a global focus. These ETFs...
So they do the picking for me again?
They do the picking for you. They hold a basket of dividend-paying stocks from companies around the world.
So it's like a one-stop shop for international diversification.
It is.
Are the ones that focus on like a particular region?
Yes, you can find ETFs that concentrate on specific regions. Like Europe, Asia, or emerging markets. There are also country-specific ETFs if you want to target a particular country.
All right, so I can really fine-tune it.
You can really fine-tune it.
What if I want to do it myself, though?
Okay, if you want to be more hands-on, many reputable financial websites and brokerage platforms provide in-depth data on international companies, including their dividend history, financial performance, industry outlook, and even those country-specific regulatory details.
Well, I can really get a clearer picture.
You can get a very clear picture of the company's overall health.
But that can be time-consuming.
It can be time-consuming.
So are there any shortcuts or tools to speed things up?
Screening tools can be incredibly helpful. Many financial websites offer these tools that let you filter companies based on specific criteria, like dividend yield, payout ratio, market capitalization region, or even ESG factors.
It narrows it down.
It narrows it down, makes it
easier,
and lets you focus on companies that meet your specific investment criteria.
That's great.
Yeah.
But I still got to do my research.
I still have to do your research.
The screening tools are a fantastic starting point.
Right.
But they're not a substitute for thorough research.
Yeah.
Always dig deeper into the companies that catch your eye.
Gotcha.
Look at their financial statements. Read industry reports. And really understand their competitive landscape.
Don't make sure you're comfortable with the company's overall fundamentals.
Right. Trust but verify.
Exactly.
And don't forget about those ESG factors.
Yes, absolutely.
Make sure those international companies.
Yeah. It's important to see how they're performing in those areas as well.
This has been really eye-opening.
It has.
Like, I feel like I've learned so much today.
Good. I'm glad.
Just about dividend investing in general.
Yeah.
You know, from the basics of like how that compounding works and then to like how to actually analyze those financial metrics and then to like all this international stuff.
The ins and outs.
Yeah. And ESG.
Yeah. ESG is becoming increasingly important.
A lot to take in.
It is a lot to take in.
But I feel like I'm much better equipped now.
Good. I'm glad to hear that.
So at least like start exploring.
Yeah. It's all about, you know, taking it step by step.
Yeah.
And building your knowledge over time.
Absolutely.
Remember, investing is a lifelong journey.
Yes. It is not a race.
It's not a race. Yeah.
Take your time. Do your research.
Right.
And don't be afraid to ask questions.
Absolutely well said.
Thank you.
I'm feeling very inspired now to keep learning and keep diving deep into this world.
It's a fascinating world.
So to everyone listening, keep exploring, keep learning, and happy investing.
Happy investing, everyone.
Until next time.
See you next time.
Yeah, ESG is becoming increasingly important globally.
Absolutely. Okay, so we were talking about those country-specific factors.
Right.
Currency fluctuations, political and economic stability.
Yep.
All that good stuff. Are there any other...
Yeah, I mean, I think another key consideration is just, you know, different countries have different regulations.
Right, of course.
Yeah, when it comes to things like corporate governance, financial reporting, and even dividend payouts.
Wow. Okay, so it really is like navigating a whole new set of rules.
It is a whole different set of rules.
Are there resources that can help me with that?
Yes, definitely.
Right.
There are reputable research firms, financial websites, international brokerage platforms that provide a wealth of information on international markets companies and those specific regulations that we talked about.
So I don't have to go in blind?
You don't have to go in blind.
Okay, that's good.
You can also consult with a financial advisor who specializes in international investing if you're looking for more personalized guidance.
Gotcha. So where do I even begin to find?
Yeah, that's a good question.
These promising international dividend stocks.
So one convenient and diversified way to tap into those global dividend opportunities is through international ETFs. Similar to the Schwab ETF we discussed earlier, but with a global focus.
They're picking the stocks for me again.
Exactly. They do the picking for you. They hold a basket of dividend-paying stocks from companies around the world.
And are there specific ETFs that focus on like certain regions or countries?
Absolutely. You can find ETFs that concentrate on specific regions, like Europe, Asia, or emerging markets. There are also country-specific ETFs if you want to target a particular country.
So I can really fine-tune my strategy.
You can really fine-tune it.
And what if I want to take the hands-on approach?
If you want to be more hands-on and research individual companies yourself, many reputable financial websites and brokerage platforms provide in-depth data on international companies, including their dividend history, financial performance, industry outlook, and even those country-specific regulatory details.
But all that can be kind of time-consuming.
It can be time-consuming.
Are there any like shortcuts, tools?
Screening tools can be incredibly helpful. Many financial websites offer these tools that let you filter companies based on specific criteria, like dividend yield payout ratio, market capitalization region, or even ESG factors.
So it helps me narrow it down.
It helps you narrow down your search. And focus on companies that meet your specific investment criteria.
But I still got to do my own research.
Absolutely. You still have to do your own research. Screening tools is a great starting point.
They're just a starting point.
Well, they're not a substitute for thorough research.
Trusted, verified.
Exactly. Always dig a little deeper into the companies that catch your eye. Look at their financial statements, read industry reports, and really try to understand their competitive landscape. Make sure you're comfortable with the company's overall fundamentals.
And ESG.
Yes, absolutely.
That's got to be part of the picture.
It's becoming increasingly important globally.
This has been so interesting.
It has been a really interesting discussion.
I feel like we've only just scratched the surface.
There's always more to learn.
There is.
Yeah.
But I feel like I have a good foundation now.
I'm glad to hear that.
At least to get started.
Yeah, and remember, investing is a lifelong journey.
Yeah, it's not a race.
It's not a race. Take your time, do your research.
Absolutely.
And remember, diversification is your friend.
I'll keep that in mind.
And most importantly, stay curious.
Yes.
And stay informed.
Well said.
Thank you.
Thanks for joining us today.
It's been a pleasure.
And to all of you listening, happy investing.
Happy investing, everyone.
Until next time.
See you next time.